Factors that can lead to a successful retirement, but one of the most important and overlooked are your taxes. Back with us today are Gary Mattson and Laurel Stewart, the father-daughter duo, part of the Mattson Financial team, a full-service financial and retirement firm in the Grand Rapids area. They're also popular radio show hosts. Good morning. Thanks so much for joining us.
Good morning.
Good to be here.
Thanks so much for joining us. And first off, I'd like you to really clarify something, if you don't mind. What's the difference between a tax preparer and a tax planner?
Yeah, so really easily confused, but a tax planner is somebody who actually is going to look at a plan, look at a strategy, put that in place for you, and go over some different recommendations. Whereas when you have a tax preparer, that's somebody who, you're going to take in all of your documents, all of your statements and things, and simply prepare for what you have, not necessarily giving you a strategy or advice for the future.
So a planner will actually help you long-term reduce your tax bite, if you would, on the amount of money you owe. It can be done one time, or it can be a strategy that's stretched out over years.
So why is tax planning such a focus of the wealthy?
Well, it's really about keeping what you earn. So number one, you want your money to work as hard as you did for it, but then also you want to keep as much of it that you're legally obligated to do. So planning, not just for the wealthy, but tax planning, lets you keep more money. Let's look at it. If you save 2% in taxes every single year on a $500,000 portfolio, that's an extra $10,000 a month. That's serious money when you think about it longevity-wise. And so it's not just the absolute wealthy that do tax planning. Once we get clients to really look at it and focus at it, they can actually see that they can control how much they're paying in taxes, and you get to keep those dollars. Because what it's about in retirement isn't how much money you've got. It's how much money you get to keep as income flow. So it's about income flow, making sure as these things or events come along, Social Security and other things, you're not overburdened with taxes that you shouldn't actually be paying.
That's right, because you have those taxes, as you said, coming at you in your 401k, your IRAs, your RMDs, all those good things. So, all right, and of course there is the concern about taxes going up and what that could do to you.
Absolutely. So yeah, you mentioned your IRAs, your 401k. Those are pre-tax dollars. You haven't paid taxes on it yet. RMDs, that's your required minimum distribution. So once you reach the new age now is 72 moving forward. So once you reach that age from your IRAs and your 401ks, you have to take a certain percentage. It's mandatory every year. And if you don't, it's a 50% penalty. So really want to make sure you have that marked on your calendar. But you don't want to be in a position now with your RMDs at 72 where you have to take money out and you don't need it and now you're paying taxes on it. So we want to be proactive with that strategy, really looking at that. And like you had mentioned, Leanne, we do have some changes. A lot of stimulus has happened over the last year and this year now. Our national debt is raising, so we know at some point in time in the future taxes are going to go up. So there's no better time to really look at it now, knowing that the Trump, tax plan is either going to sunset or going to repeal here shortly. So just be mindful, sit down with your preparer, your planner, and your advisor, and making sure you do have a strategy in place.
Yeah, they should be coordinating together.
And what ways can people reduce their taxes through the way that they save?
Well, there's different avenues to put money away. Of course, taking money out of your check and put it into your 401k, especially if you have a company match, is huge because you've already made 15, 20, maybe up to 100% on those dollars if it's 100% match. Then that's tax deferred. There's other ways that even though you're in retirement, you can have a Roth IRA. So a Roth IRA is money that you've paid taxes on, and now it grows tax-free for the rest of your life. So if you've got an asset that you're never going to pay taxes on, and that grows significantly, that's wonderful for you in your portfolio from a tax point of view and required minimum distribution. But that's also wonderful for your beneficiaries, your children and grandchildren. Because when you pass that to them, they're never going to pay taxes either. And so many people come to us, they're in retirement, they don't have a steady income coming out of a workplace, they have it from their retirement accounts, and don't realize that's one of the things that they can do in retirement.
And then if we reduce taxes, does that mean more money in our pockets and then less to Uncle Sam?
Absolutely. And so, looking at that, just being mindful, federal tax rates, you start at the 12% and the next jump up from there is 22. So really that's an extra additional 10%, plus you have your state, which in Michigan is 4.25, plus your city if you live in Grand Rapids or anything like that. So being mindful and knowing for every dollar that you take out, 28 cents or maybe 30 cents on the dollars is going to Uncle Sam, you want to make sure that you're actually taking out the amount you need to spend and not necessarily having it accrue either in your bank, because we know that you're getting 1% or less in interest there. So you really want to make sure you have a proper investing strategy with that proper, plan of how you're distributing that money to you and for your family and your living expenses.
Because let's face it, we can't control what the market does. When it goes up, it goes up. When it goes down, it goes down. We can control how we react to that. But other things we can control is the tax base, like Laurel said, is that's making sure that you're in the right tax position. Because don't forget, if you go over that level, just by $1, you're now increasing from a 12%, like Laurel said, to a 22%. That's an extra 10%. And every one of those dollars hits that number, that could be catastrophic for long-term investing, so you would possibly run out of money. So it's making sure you have the assets at the proper tax level to do what you want to do and not cross taxes that you otherwise should not.
Definitely eye-opening. All right, you guys do have something for our audience at home?
For the first 5 callers, if you've saved $250,000 or more, we invite you in for a complimentary meeting with one of our advisors here, Gary, Gerald, or Taylor, to talk about your retirement dreams. What are those goals and desires you have? And then what we're going to do is work on a plan with you and put that together into what we call a retirement roadmap, so you can see any of those tweak or recommendations to be made along the way to get you to a successful retirement.
All right, so for you at home, if you're looking to make sure you have a proper tax strategy for retirement, Mattson Financial has a great offer right now. Again, for the first 5 callers that have saved $250,000 or more that are retired or nearing retirement, they're offering a complimentary full-blown retirement plan just for you. This will allow them to sit down with you personally and provide you with a roadmap, analyzing where you are right now and discuss your best steps to really get ready for a successful retirement. A game plan to get you where you need to be. The number to call is 616-514-3831. Again, 616-514-3831.